Welcome. It's Tuesday, the 5th of August. It's Money Matters and it's episode 7. It's a pretty quiet week, so we're talking today about taking stock and thinking about market valuations, what's happened so far, some macro triggers that may be around, and what potentially we should think about when we're positioning in a portfolio setup. So let's start with a couple of macro comments. Certainly last Friday was pretty eventful. We had the Amazon numbers, which disappointed and resulted in the stock down some 7 or 8%. But more importantly, we then saw a couple of economic events occur, one of which was the slowest growth in employment since 2011, which the market took as a very bad omen on the basis that unemployment could start to increase. And if that were to be the case, then we're more likely to see the economy slow down to the point where tariffs then start kicking in, inflation takes over, and we're in what's known as a stagflation environment, which is pretty much the worst case economic scenario you can think of. So the market took a hit on that. But it also took a hit on the basis that one of the Fed governors, Kugler, has decided to resign 5 months early. Of the 7 voting members, that now means that 3 will be Trump appointees and follow and toe the line. And so that has also changed the perception of the independence of the Fed, which is clearly something of an issue for investors. Trump then decided that he was going to sack the head of the labor statistics department on the basis that this news displeased him. And so the markets took a very dim view of that as well. If you kill the messenger, the message still remains the same. So what does it potentially mean? Well, you're creating a further hurdle in terms of visibility to the economic environment. That will create more uncertainty longer term. Whether you decide that you're going to doctor the labor statistics or not, and I'm not suggesting that the administration would do such a thing, but rather that the impact of whatever goes on in the Labor Department of Statistics will show up somewhere in the economy over time. But we just won't be able to see it in time. So it's not particularly helpful. It shows a further deterioration in the independence of statistics, in the independence of the Fed, and potentially raises the stakes a little bit in terms of the risk profile. So with that in mind, let's take stock. 90% of companies have already delivered their announcements. In general, the earnings season has performed well. Valuation has always been cited as the reason why you should be diversifying out of the US. In terms of the S&P 500, the forward PE is 22 times. The growth in earnings, at least based on consensus for 2025 into 26, will see 14% growth according to FactSet. And just keep in mind that 35% of the S&P 500 is the Magnificent 7 stocks. So let's therefore filter out those Magnificent 7 stocks and think about what their valuation looks like today. The Mag 7 is on 28 times forward earnings, not surprisingly, because they have a higher growth rate in terms of their earnings. It's 18%. But if we take out Tesla and NVIDIA, Tesla is on 100 times forward earnings and NVIDIA is on 40 times forward earnings. Extract those from the equation and the Mag 5, if you like, comes down to about a 24 times forward earnings with still similar growth rate in terms of their earnings. So to me, what that presents is a market that still has interesting value to it. It's certainly more expensive than Europe. The European stocks 50 index is trading on 15 times forward earnings. but only has some 9% growth in forward earnings to come. And that really exemplifies what the structure of the European index looks like. It's 45% in banks and industrials. These are very cyclical sectors. They're capital intensive and therefore have much lower margins and a lower opportunity to generate earnings. So putting all that into context, I would suggest that the US market, despite seemingly more expensive than the European market, still remains the first port of call from an investment perspective. The other elements that I think will drive the US market in the second half that the Europeans don't have is a number of factors, including the increasing deregulation that the administration is bringing to bear. This is very good, particularly for the technology sector and financials. The Big Beautiful Bill is a form of deregulation in its own right that creates a loosening in the fiscal environment. A loosening in the fiscal environment would imply more consumer activity. That's good for the discretionary retail sector. The US market is showing significantly more momentum than Europe as a G7 play in terms of developed markets. The US market looks more expensive, but when we look at it from a growth perspective, it's sitting in a reasonable place. So what can deter the US from leading the performance, if you like, for the rest of this year? I suspect that tariffs will play a big role in this. The tariff impact is not going to be insignificant. It is inflationary, but it is likely to be spread over a combination of three economic players. That would be the corporates in the US. It would be the exporters of product from those countries that have been tariffed, and it would be the consumer as well. It implies that the buying power by the consumer is to some extent affected. Certainly that implies some level of inflation, and it really depends on the competitive environment of any specific sector, which prices are passed on to the consumer and which are swallowed up by the US company that's making or importing that product. So to some extent, then we are more likely to see one-off inflationary environment. That is not pleasant, but it may not be as significant as the gross tariff numbers imply, because various parties within the economy will swallow that effect. However, a margin erosion is likely because to some extent those companies will absorb the impact of tariffs. If there is a margin erosion, some cost cutting was likely to occur, and that would potentially lead to an increase in unemployment. We're still at near full employment levels at 4.3%, but if we start creeping up towards the upper level, then we might start to see the Fed getting a little bit more panicky and look to cut rates. But always they will have one eye on the inflationary pressure coming from tariffs. So their hands are tied. And I think that could potentially cause an issue. All of those things can be deterred through the fiscal opening of the sluice gates by the Big Beautiful Bill that's going to be enacted within the second half of this year. And so from a pure liquid portfolio, and I'm not talking about a holistic portfolio that includes unquoted assets like real estate and private equity or venture. So just from a pure liquid perspective, my conclusion is that for the rest of the year, the US market is likely to perform relatively well. We're likely to see, therefore, a equity performing better than bonds, although bonds will do well as well. So an equity split of 70-30 is, to my view, aggressive but justified towards equity. And within that 70% equity, that we have a 60% exposure to the US, where that is likely to continue to lead the performance, given what we've just discussed in terms of the various momentum levers that are in place for the market. And within the US, I would stay at market weight in terms of the S&P 500 exposure towards technology. Technology at this juncture is not out of sync in terms of valuation when you consider the growth rate opportunities that it has, the AI upside that's going to come through to some of the businesses therein, particularly the likes of Meta and Google, who are net beneficiaries of the AI play, given that their advertising business is wholly reliant on better optimization through AI. And to some extent, we're also likely to see that CapEx spend on AI that we've heard from the announcements from last week benefit the semiconductor sector as well, with NVIDIA, Qualcomm leading the charge. Tech is not expensive when you consider it from a growth perspective. However, a close eye needs to be kept on the inflationary pressure coming from tariffs, the impact that would cause unemployment. And if the market starts to fear a stagflation environment, then that is the one single bugbear that hangs out there in the second half of this year. As always, please do your own research. These are simply an opinion stated by myself. These are not inducements to get you to invest in anything specific. Ask your financial advisor, do your own work, and have a wonderful day.